Welcome to the Brain Picker Pros Show, live from Lake Wiley, South Carolina. This is going to be a really, really good show. I've had so many people that are out there doing our filthy richest deals. And they always ask me, Larry, who do I use for an RMLO, residential mortgage loan officer, that can take a look at my borrower, right? And can take a look at my borrower, can originate that loan, and give me some feedback on that and let me know if they have the ability to pay, right? So I found a guy. I know many students that are already using him, and he's working nationwide. So today is the day you get to hear from the man, the legend, and the myth, Mark Ross with Good Steward, right? Is that it?
Good Steward Lending Services.
Good
right.
Steward Lending Services. Now, I'm going to be upfront with you. I haven't used your services yet, but I'm in line, right? I'm getting ready to, right? So I'm really excited about it, and I do know some students that are already using you, but as soon as I found out, I wanted to get you on and have you talk about it. So welcome. Thanks a lot for being here. I appreciate it.
Thank you, Larry. I appreciate the opportunity.
Awesome, man. Awesome. Yeah. First of all, why don't you start out and tell our viewers a little bit about yourself, your background, and then you can kind of move into Good Steward.
So I've been in the mortgage business since the 70s. It was right after elementary school I decided to get into the field. That's the way it works. But I've been a mortgage broker since 1976. So it's been a long time.
Yeah.
And I cut my teeth on private money lending. That's what I did for the first 10 or 15 years of my career, was exclusively in private money. And then we branched out and ended up having FHA and VA and conventional and the traditional type of lender. We were a mortgage broker, and I ran my own shop for about 25, 26 years, and then ultimately moved my operation in with Good Steward, and because they had some opportunities for me to expand in the different arenas that we do here at Good Steward.
Right.
So I felt like it was a good match. So I'm still doing all the traditional lending that a regular home mortgage shop will do.
Right.
But we also do the private money and the commercial, and we deal in paper. And then when Dodd-Frank, I call it the Mortgage Loan Originator Employment Law, because that seems like what it did was it created an opportunity for mortgage loan originators to have another vehicle of revenue, which comes from the RMLO approach that Dodd-Frank requires. So it's not been obviously a huge job or a huge industry, but there's some facets of it that make it worthwhile. And so we've decided to kind of jump into it and have as an adjunct to our normal business.
That's good. That's really good. Now, we're going to talk a lot about Dodd-Frank and about that process and everything. In fact, we got some resources that you're going to give out that we'll have here on the page. But tell us a little bit about your traditional lending business, because maybe there's some people listening that maybe need, just a traditional type of loan or something like that. Tell us a little bit about that side of the business.
Well, that's more specifically, that licensing issue is much more focused. What ends up happening to that is the problem with mortgage companies that offer these types of loans is simply you have to be licensed in the state where the property is. And so because of that, our license, we're licensed to do business in Arizona and California,
right.
But I pretty much exclusively do the mortgage stuff, the traditional home loan stuff, just in Arizona.
Right.
It's just each individual loan officer needs to be licensed in that state in order to be able to accomplish that thing. So we're pretty much focused for the traditional stuff in Arizona.
Right. Okay. That makes sense. Now, what about you do some buying and selling of notes and do some private money lending or something as well? Tell us about that.
So I've kind of taken that one on. That's an interest to me that I've had since I started in the business. And paper is a really an interesting commodity. It deals in a lot of areas. Obviously, when you have a seller carryback scenario, you're dealing with paper. It's a security, and that security can be utilized in a variety of different fashions. You can sell it, you can split it up, you can borrow against it, you can trade it into property. There's a lot of opportunities when you deal with paper. And so I started to play with some things. I took some courses. As you know from giving courses, there's always a a good opportunity to learn from people when they take courses. And so I'm a proponent of that education piece as well. And I've taken some note courses and things of that nature. So I found that we got pretty creative in the structure of how we deal with paper today. So we can buy it, we can buy the whole note, we can buy a piece of the note, we can lend against the note. We just and that we can do nationwide. So that paper is not restricted by Dodd-Frank or other licensing rules for the most part. So we can deal with that paper pretty much across the country.
That's really good.
So paper is a great opportunity for people to deal in real estate.
That's really good. So I'm assuming a lot of the paper you're buying is probably paper that was created through seller financing transactions.
Yes, that as well as, interestingly, a lot of institutions will sell their portfolio of paper. So you can have both performing and non-performing paper.
Right.
On the open market, you'll see 10, 20, $30 million pools of paper that are out there for sale. So if you want to get really aggressive and big, you can jump in with both feet and participate in that arena. I'm more on the lower end of the scale. I deal in the onesies and twosies. And so that's the market that I prefer because that's where my money comes from. It's more efficient that way.
Right.
But there are opportunities, depending upon how aggressive you want to be, to deal with those large pools.
Right. Now, are you guys using do you have a fund put together, or are you just using private individual investors to buy them, or your own money?
All three.
Oh, good.
We buy with our own money. I have a bank of about 150 private investors that I've amassed over these few decades. And so they are people that I rely on a lot for our transactions. And then one of the reasons I mentioned that I came over to Good Steward is because one of the pieces that they provide is our funds. Right. We have mortgage pools and mortgage funds across the country. So we're doing that type of thing as well. So there's a variety of different resources that we have to go to get money to try to move through the paper or real estate or whatever it may be.
Yeah. Now you've got a pretty extensive seller carryback education or experience, don't you?
Right. I pride myself on that. That's just an area that I like. It's interesting to me, and I just want to continue to do that type of business. It's worthwhile, and I like to grow it. And, one of the reasons I decided to do the RMLO part of the process was because I thought it would give me an avenue into some paper.
Right.
When a seller carries back a piece of paper, they may or may not want to. They may want to move through that with some other opportunity. So that's why I decided to use paper or RMLO as an avenue towards that paper.
Wow, that brings me to a whole nother level here, and we're just getting started. But is that something that you might be able to, and I should probably save this question for later, but is that something that if someone sends you a deal to take a look at, to originate, because they are seller financing it to comply with Dodd-Frank, is that something you could look at it and say, hey, if you end up selling them this house with owner financing, if you get X down, you set up the terms this way, I'll buy this note or I'll buy a partial or whatever? Yes,
we can both help them in structuring it as well as giving them some offers on that paper.
Man,
yes.
That's huge. That's huge. Now, do you require any seasoning for that, or can you buy it right at the table?
No, we can buy it right at the table. Obviously, a seasoned note has a little bit more oomph to it, but loan to value is really what drives those transactions. So the equity exposure is what we're going to be most focused on, and seasoning is a consideration, but in my opinion, it's overrated. People think about, well, the guy's never hadn't made a payment. How am I know he's going to? Well, if he doesn't, the loan to value protects me. So
there you go.
So that's why we don't focus too much on seasoning. We're more focused on exposure.
Right. And I don't mean this in a bad way, but if they don't make a payment, that's probably the best thing that can happen, right?
To some of my investors, that's true. They're very aggressive. They're looking to pick up real estate. If they can buy it at 50 cents on the dollar, I mean, that's great. But most of my sources of money are more looking for performance. They're not necessarily looking for the foreclosure process.
Right.
But certainly that's your backup position, your protection.
That's good. That's good. Okay, let's jump in and talk a little bit about the Dodd-Frank stuff. Tell us a little bit about the whole, just for some people maybe watching this and they're interested in seller financing, maybe they've heard about Dodd-Frank, and just Googled the term and up popped this podcast. So explain a little bit about what Dodd-Frank is all about and why it applies to us that's doing seller financing.
After the mortgage crisis of 2008, there was a need for new legislation. And one of the things that happened was Dodd-Frank. Now, it came about because of two senators, Dodd and Frank, who are actually House of Representatives. I guess they're both in the House, not the Senate. But they are both gone now. But they produced this documentation that created a major upheaval in the finance arenas. And in fact, right today, there's a bill going through the Senate that is going to be presumably reversing some of the Dodd-Frank rules. But mainly those apply to the large banks.
Right.
They're not going to apply. I haven't seen anything that it's going to affect the seller carryback side of things. I would love it. I would love for my job to go away, to tell you the truth, because it's ridiculous to be able to have to go through this process to sell your own property. But the Dodd-Frank rules restricted significantly the ability of mortgage companies as well as sellers to finance property. So on the mortgage side of things, it really impacted the ability for me to be able to make a loan to an owner-occupant using private money funds because of the restrictions that are placed on the terms of that loan and the qualifying for that loan. So it has effectively eliminated the ability for an owner to finance their own home using private money sources because of the Dodd-Frank rules. And seller carryback, that's a whole other section, and the seller carryback was trying to make sure that if you put a buyer into a piece of property, they're not going to be put in a position where they're not going to be able to perform. So they wanted these rules established to make sure that that qualifying process is reviewed. That's one of the main strengths of that's where the RMLO process came about, because if you do 3 or more transactions in a 12-month period, you need an RMLO, a residential mortgage loan originator, to review that transaction. You must hire somebody that's licensed in order to do that. Now, if it's 1 or 2 sales in 12 months, you don't need it.
Right.
But 3 or more, you do. So they did put in an exception to allow somebody who, let's say, an individual who's not a real estate investor, who's somebody who just has a piece of property, they decided they want to move to a different location, they have this house, they don't want to sell it for cash, they want to create that paper, so they were able to sell or carry back it, and there's no problem because they can move on, because they're not doing more than 1 a year.
They're not in the business.
They're not in the business. But the problem is, it's a 12, the rule looks back 12 months, not forward. So if you may sell one piece of property today and then have an opportunity in 9 months to do another one that you never thought you were going to do, now you fall into that 2-property sale scenario that you didn't know about. And from that 2-property sale, it's going to look back 12 months to see how many transactions you've done to see if you've been in compliance with the statute. Right. So it looks backwards, not forwards in compliance. So if you have a half a dozen properties and you think you're going to sell 1 a year and you end up selling 3, you've got to make sure you comply with the Dodd-Frank rules for all 3 properties. Even though you may have only sold 1 that you thought was going to sell, you may have only had that 1 transaction. So it does create some havoc for people, and the Dodd-Frank rules are difficult and a little confusing. Just it's a government at work, I guess, but that's what we have to deal with.
Right. You know, it's crazy that, I mean, I understand that it was needed, and I get that, but just the way it has changed the whole seller financing industry. I mean, I call it the Homeownership Prevention Act,
Yeah, that's true.
So it really
does create a problem. I used to, like I said, I've been in this business a long time, and I used to make private money loans to owner-occupants all the time, either refinance or help them buy a house.
Right.
And now, for all intents and purposes, that market's been shut down. So until they change the Dodd-Frank rules, we're not going to be able to do those types of loans. And it's frustrating. It's affected my business, obviously, but it's affected a lot of home buyers that, for one reason or another, may not be able to purchase a house. If they got caught up in a short sale or a bankruptcy or a foreclosure after the crash, they may not be eligible to get a loan,
Right.
a regular traditional loan,
Right.
until they wait a certain period of time. And so people are, there's still people having troubles from 2011, 2012, 2013 that would be good candidates for a home loan and to buy a home, but they can't do it. So that's why the seller carryback opportunity gives your students opportunities to participate in that side of things.
Right. Right. And I think it's important to note it only applies to owner-occupied buyers, right?
That's correct. It's only owner-occupied. If you're selling to an investor, you don't have to deal with this.
Right. Which is good, but a lot of the people who need non-bank qualifying financing are the people who want to become a homeowner. They're renting right now, right?
Right. And many times they can afford to buy a house easier than they can afford to rent. I mean, the numbers often favor the purchase transaction over the rental transaction.
Right.
So it's a shame, and maybe one of these days something will happen. But in the meantime, we'll just keep plugging away with what we're doing.
There you go. So tell us a little bit about what's required by the seller. Like if I bought a house and I'm going to sell it with owner financing, what do I have to do to comply with Dodd-Frank?
So the problem with that is it depends on whether it's one sale in 12 months, two sales in 12 months, or three or more sales in 12 months.
Let's say it's three or more.
Changed.
Yeah.
So under the three or more, you do have some other issues that restricts the interest rate. It restricts the amortization. It restricts the balloon. You can't have a balloon payment. You can't have, if you're going to have an adjustable rate, there's rules on the adjustable rate. There's a lot of those.
Right.
And if you become an expert in it, I've often said I would love to find an attorney in my community that's an expert in Dodd-Frank, because there aren't any. I mean, it's just a difficult world.
There's not any. In fact, the CFPB, Consumer Finance Protection Bureau, is the oversight organization for Dodd-Frank. I have called and emailed no less than probably a dozen times. How many return calls do you think I've ever had?
Right. It's problematic. It's a problem there. I teach a class on financing, and one of the things that we talk about is the CFPB, and they're the agency that oversees mortgage lending across the country, among other things.
Right.
And yet they don't comply with their own rules on their website. They quote interest rates without putting in the annual percentage rate.
Are you
where
serious?
All of us have to put in both. So those are the kind of things that you have to deal with a governmental agency sometimes. And if you look at their homepage, if you go to the CFPB homepage and you look at the homepage, in the very bold middle of it, it'll say, have a complaint. They're soliciting complaints. They're soliciting for opportunities to sue people to try to get fines and fees out of them. So it's not a user-friendly, consumer-friendly type of site, in my opinion, at least from an industry perspective.
No. Well, they're trying to protect the consumer is what they're doing, not the investor.
Well, they are, but to the detriment of the consumer themselves, because it's problematic. It just creates a lot of scenarios that you just question where they came from. Plus, they're the only agency in the federal government that has no oversight. So that's the other problem. They were funded by Congress, but they don't have an oversight. Every other department in the government either has a committee or a head that speaks to the president. This one doesn't.
No.
So they are. I understand they're trying to change that in Washington now, but right now it's the only agency that doesn't have any oversight.
And I don't want to open up a whole can of worms here, but I'm going to go ahead and say this. I know a lot of people that do seller financing, okay? And I mean, I'm out there. I teach this stuff. I'm traveling around, conventions, expos, and people ask me, Larry, who do you use? Who do you use? What are we doing about Dodd-Frank? And I always make sure I use an RMLO, and I make sure I got everything. So if I go to sell that note, I got everything right there. If the regulators knock on my door, I can show them the file, right? But you know what? You and I both know two things. Number one, the majority of the people out there doing seller financing don't even use an RMLO. I'm not advocating that at all. In fact, I'm just the opposite. I'm advocating using an RMLO to originate the deal, right? To make sure if they do come knocking on the door, then you got your paperwork in order. Plus, if you go to sell the note, you got your paperwork in order as well, right? The second thing is this: everything I've seen about the CFPB, they're going after the big banks, right? They're charging fines for the big banks, the big institutions, 50 million, 100 million, 150 million. Do you think they're going to go after the little guy that's doing 2 or 3 seller finance transactions and try to reverse a $50,000 or $100,000 deal? It's not going to help them at all, right? What are your thoughts about that?
That's true. That's true, and that probably happens in any kind of violation of a regulation or a statute. They're going to go after the big guys. There's only so many resources the authorities have to pursue. But for me, I just want to make sure my nose is clean.
There you go.
So I don't want to be caught up in that. And in any given state, you've got a problem because the state regulators, even though the big boy CFPB are not going to probably knock on your door, your state regulator may be more inclined to. So if your state regulators notices or hears about an abuse, somebody got abused and got hurt, their attorney general or that particular financing agency might very well be knocking on your door. So it's not necessarily the CFPB that's going to come after you. Maybe somebody else, though.
And that's a really good point. It may not be the CFPB. It might be that state's banking commission or whatever the regulatory authority is. I mean, I used to be a licensed mortgage broker for years back in the 90s up until the end of the 90s. And they would come by knocking on your door once a year, whether you wanted to see them or not. And they'd want to pull through and look through random files. So, if they get a complaint, they're going to research it. And the states have a lot more resources to research the smaller deals, right?
Right. That's where the rubber meets the road, so to speak. That's where it really happens, is at the state level. If you're a big abuser, you're certainly going to show up on the radar of CFPB. But it's the little guys like you and me that go out and do several deals a year. And if one of those deals goes bad and that particular consumer picks up the phone and calls their attorney general or the banking department or whatever it may be in that state, that's when you've got problems.
Right. So basically, you've got a list of a summary. If you do an adjustable rate loan, it can adjust for 5 years, then only 2% a year for the next, up to a max of, I think, 6, something like that. Is that right?
Right.
I just tell people, just do a fixed rate loan and don't worry about it, right?
Right.
Yeah.
Yeah, that was one of the things that Dodd-Frank when we first came out, we thought, well, there would be an opportunity for us we'll just stick in an adjustable rate feature to motivate them to pay a balloon off.
Right.
We know we can't do a balloon payment. We have to be fully amortized. So we'll just adjust it goes from 6% to 18%. Well, Dodd-Frank built in a provision that doesn't allow us to do that. So there were a lot of places that they made sure that the consumer was not going to be abused in the process. And if you don't structure your deal properly, that's when you can get into some trouble.
I think the biggest thing is they just want to make sure that the borrower has the ability to pay, that the seller is not selling the property for the sole purpose of collecting a down payment and then getting the house back in a few months. Isn't that
right? And there's stories of people that did that. They put people into loans that they couldn't handle, and they foreclosed and took them back. And I know one particular situation where a couple guys ended up in jail because of it.
Wow.
Because of particular practice. So it can be abused, and I'm sure that's where Dodd-Frank and a lot of the discussion when this legislation was first created, that came about how do we protect people from that type of abuse.
Right. So what is the process? What's the process? I mean, let's say that, I get a borrower and I've got a house that I'm trying to market, and I get a borrower that says, yes, I have down payment. I really want this house. What's the process? How would somebody get that information to you, or what's the process to send it over for you to qualify them?
What we would first do is send them a loan application. We use a traditional, similar to a residential loan application. It's a little bit scaled back. It's not quite as detailed, but it gives us some basic information about the buyer. And then we ask for documentation to prove it. So we're going to get tax returns, pay stubs, bank account statements, things of that nature,
right,
in order for us to understand what their financial picture looks like. Once we get the application and all the supporting documents, then we'll go ahead and pull credit so we can see what their credit picture looks like, and we will analyze their income and their assets and their liabilities to see what their ratios look like, to see if they're going to be in compliance. And then we provide a report to the seller that outlines all this information. So that's kind of what the RMLO does, is analyze the information that's been provided so that the seller can make a decision as to whether they want to proceed with that sale or not proceed. We're not making any decisions. We're just providing information.
And I've seen your reports. I really like them. I like the way you explain everything. You know, I mean, you might even say something like, these people have the ability to pay, but it doesn't look like they have the willingness to pay, right?
Right.
Yeah.
Right. I'm going to give my opinion in there.
That's good.
I'm just trying to suggest, you know, a number of the deals that I've done in this regard, I'd say probably a couple of dozen or more of them have been very low down payment, you know, $1,000, $2,000 down with a seller carryback. And most of those types of transactions were dealing with borrowers that have, or buyers that have, pretty weak credit. Right. And so the combination of a very low down payment and weak credit, you have to recognize whether or not you want to sell under those circumstances. As a seller, you have to decide, do I want to sell to somebody in that circumstance? They may qualify under Dodd-Frank, but you still have to make the decision, do you want to sell under those parameters? And then if you are going to sell, and now you have that paper and you want to move through that paper, you're going to have to deal with somebody else looking at their credit qualifications to decide, do I want to buy that paper?
Right.
So you have to make some decisions. Not only do I want to sell the property, but what's your more exit strategy down the road to move through that paper, if that's in fact a goal of yours.
Right, right. Now, you get the borrower's information, or someone like me will send you the borrower's information. You'll send them a credit app. You get all that information. When you put it all together, then you're going to send me a report, right?
Right.
Yeah. What all is included in that report?
Well, the report goes through a variety of different areas. It first of all talks about the property briefly. But the primary focus is on the borrower. So where do they work? How much money do they make? What's their credit picture look like? Do they have any foreclosures, judgments, bankruptcies, delinquencies? What about their assets? Where's their money coming from? Do they have residual income where after their mortgage payment is paid, do they have extra money to live on?
Right.
What about their capability for being able to pay their other obligations? Do they have a high car payment or something of that nature that can impact their abilities? So we're going to look at all those things. We're going to provide ratios. There's a few different standard ratios we use, obviously loan to value, but we're going to use their front end and back end debt ratios for the analysis. And then we're going to grade the credit, and we're going to give them a grade of excellent, fair, or good, fair, or poor based upon their credit score. So, and then we're going to do some commentary on that. So it's just it's not a PhD essay, but it's a summary analysis of what somebody is going to want to know in a quick fashion as to whether they should or should not sell.
So in a nutshell, it sounds like you're basically evaluating, do they have the ability to pay, and do they have the willingness to pay?
Right. I am, but I'm not making that call.
Right. It's ultimately the lender's decision. You want to be very clear about that.
Right. It's the seller's decision as to whether they want to. I'm just telling you what their debt ratio is.
Right.
Debt ratio, one of the requirements for Dodd-Frank is, or for what's called QM, qualified mortgages, which is a standardization in the industry right now, a 43% debt ratio, maximum debt ratio.
Right.
So I'm going to state this borrower does or does not meet the 43% qualified mortgage ratio.
Right.
Well, that qualified mortgage, in effect, is your threshold number for ability to repay.
Right.
Because if they fall under that 43% ratio, it's presumed they have an ability to pay.
Right.
If they fall outside that, it's presumed they don't.
Right.
Even though they could, they may not.
Right.
So I'm going to tell you that it's a 43%, it meets or does not meet that 43% ratio, but I'm not going to tell you whether they do or do not have the ability to repay. It's just because I'm not approving the loan, I'm just providing a summary analysis. It changes the dynamic of how I provide that information.
Sure, sure. Well, what does a typical deal look like that you see come across your desk with seller financing? What's a typical type deal?
Oh, we've seen some $50,000 sales price, $1,500 down, 15-year financing at 11% interest rate, with a couple that, I remember one where the buyer, it's a husband and wife, and they both work at Burger King. He's a manager, and she's on the line. They had minimal down payment. They had a lot of student loans. They didn't have good credit. I mean, that's pretty much a standard type of a picture.
Right.
That you might run across. And yet, I don't know whether my client who I did the analysis for actually sold to them, but I presume he did.
Right.
Because his motivation is to sell.
Right.
That's his focus. He buys a property for 20, puts 10 into it, and sells it for 75.
Right.
He'll take that risk.
Right. Right.
And that's the type of scenario that we see, pretty often.
Right. You mentioned 11% interest with this particular client or seller. I've heard a lot of things across the board about, with Dodd-Frank, you can only charge X% interest. What are your thoughts on that?
There is a provision that predated Dodd-Frank called Section 32, which is HOPA, which is the high-priced mortgage.
Right.
And that can come into play on owner-occupied as well. There's a provision on there that's been modified with Dodd-Frank that if you exceed certain rules on interest rates, you may be affected by a violation. You may be challenged on the rate.
Right.
So you have to be a little careful with the interest rate, but there's pretty much a fair amount of latitude. I mean, if you can sell and carry back a 10% interest rate, you're probably going to be in compliance. It drives off of the APOR, which is different from the APR. But the APOR is the I lost the acronym means something, and I forget the exact title. But you can look up APOR and Google it, and you will find that rate. And that rate is a standardized rate,
Right.
and HOPA drives its violations off of that rate. So if you're X% too high above that rate, you may have a violation.
Oh, okay. Okay.
So that can come into play on some situations as well. It's just, you have to be a little careful about interest rate, but that's probably one of the least things you have to worry about, actually.
Well, you mentioned 10%. I've heard a lot of people mention 10%, so I just do mine at 9, just to make sure.
Yeah, and you're probably fine. You're going to be fine.
Because at the end of the day, you know this, you're not making your money out as much off the rate anyway as you are off of the spread from what you bought it for and sold it for.
Right.
Right.
The interest rate's not the important piece. What's important is the payment and the spread. So that's what's going to give more value to your note.
Right.
Is the payment. So if somebody's paying $500 a month, it's going to be more valuable than somebody paying $400 a month. It's irrelevant what the interest rate is.
Right. The quicker you get your money back, right?
That's right.
That's the less discount you have to take.
Right.
That's good. So what kind of deals are you looking for? If somebody says, hey, I want to structure my deal so Mark will buy it. What kind of deals are you looking for?
Well, we like partial notes. We favor those over full notes. First of all, discounts are pretty heavy on low down payment transactions. So the sellers who have those are not as comfortable in accepting a big discount.
Right.
So we've kind of transitioned over to the the side of the equation where we're dealing with partials. So we may buy 5 years worth of payments, as an example.
Right.
And at the end of 5 years, you get the note back. And now you can sell another 5 years if you want, or you can keep the note or do what you want. It gives more flexibility to the note holder because they're going to get cash now, they're not going to take a discount, and they're going to get that note back at some point in the future. And if you add those two figures together, it's generally higher than the balance of the note today. So it usually works out very well for note sellers when they sell partials.
So basically what you just said is let's say you have a 20-year loan and you sell 5 years of that note every 5 years, you're basically going to get more than the face value of the loan.
That's correct.
Yeah.
Because there's interest on that note that continues to be earned.
Right.
And so that balance doesn't drop. It's not a principal-only payment. If you had a principal-only payment, then it's problematic. But if you had anything with an interest rate in there that's going to amortize over a period of time, that's the value of it.
Right.
You're just going to get more money out of it that way.
Right, exactly. Because the principal doesn't go down, 20% every 5 years, right? Or 25% every 5 years. Right.
It drops. It starts to escalate. At the beginning of the first 5 years, it's very little principal reduction. The last 5 years of the note, it's going to be pretty hefty principal reduction.
That makes sense. So what happens if someone defaults during that 5 years and you only bought 5 years of the note?
So we have two provisions. One, if they default, and the other is that they may pay off early.
Right, okay.
And both of those circumstances could occur. And so what we do is we create an amortization schedule based upon what we're buying. So if we're buying 5 years, at the end of 5 years, our balance is zero.
Right.
So we create a sub-amortization schedule just for our side of the transaction. And then if it pays off in the 37th month, that's the payoff figure, and the borrower comes in with X, our price is Y, and the note holder who sold the note gets the spread difference.
Right.
So they're still gonna do fine.
What if they default?
Same thing. We're gonna go back to the note seller in the first place and say, we've got a default situation. Do you want to buy us out? And if they do want to buy us out, we'll look at that amortization schedule, and that's the price to buy us out. If they choose not to buy us out, then we're going to foreclose, and they're going to get wiped out.
Okay.
So most often, it hasn't happened yet. I haven't had a foreclosure in that scenario, but somebody could come in and buy us out, and then they would foreclose and take back the property. If they don't have the capacity to do that, we might work out some arrangement where they, especially if it's out of state for us, it's a management problem for us. We may work out a relationship. All right, we just want X number of dollars when we foreclose and take back the property, and you come in and handle the property and then sell it, and you get the difference.
Right.
So we may work out a partnership with them.
That's impressive. You saying that's never happened as long as you've been doing this. That's huge. You're a good underwriter.
We haven't had it because we're not going to give 90 cents on the dollar.
Right.
We're going to give 50 cents on the dollar or something. There's not going to be that scenario. Just there is defaulted notes that happen all the time, but our experience in what we've done has been we're probably pretty lucky in that respect. I would expect us to have had a foreclosure by now, but we haven't.
And you're a good underwriter.
Well, we hope to be. I mean, that's why we've been in business for all these years, I suppose.
That's good.
So,
now, do you
avoid the lawsuits?
Would you prefer a seller selling a property on land contract, or do you prefer mortgage states versus deed of trust states? How do you feel about the difference between mortgage and deed of trust states and land contracts?
So in most states, the land contracts gives you a faster foreclosure process if there's a low down payment. That's usually what the benefit is under a land contract. But deeds of trust, depending upon the state, can allow you to foreclose much faster and easier without a headache. If you foreclose if you do something using a contract or a land contract, and then you want to do something with a paper down the road, it does create a bit more challenge because the land contract, the vested interest is in one party's name and the equitable interest is in a different party's name.
Right.
That's at least how we do it out here. I assume in South Carolina you have similar types of
same thing
structure. And so with a land contract, the equity, who's got the equity? and who's got the equitable interest and who has the vested interest. And if you have to take a land contract and then go ahead and sell the next 5 years of it, there's going to be a problem in figuring out who's the equitable and who's the vested interest. So it creates a bigger challenge than a deed of trust would. But in the, east of the Mississippi, it's, a lot of times it's going to be more mortgage states or land contract states. West of the Mississippi, you're going to find more deeds of trust.
Right.
And so we find that the deeds of trust are just simpler in the most part, but we'll do both. We'll do mortgages as well. Mortgages, deeds of trust, or land contracts.
So you don't shy away from the mortgage states because they can take longer to foreclose.
We do look at those with a different eye, because the mortgage states, because of the foreclosure process, we're going to be more concerned about what transaction we're doing. Now, this is not the RMLO side of things. This is just if we're dealing with paper.
I get it.
Somebody comes to me and says, I have a note and deed of trust I want to sell, or I have a note and mortgage I want to sell, or I have a land contract I want to sell. All three of those are going to be looked at differently, even with the same terms.
Right.
Depending upon the state's rules.
Right. Okay, good. So, if someone wanted to, they've got a property that they want to sell or finance, and they want to make sure that they're Dodd-Frank compliant, how would they get in touch with you, to send that borrower to you?
Well, I believe your website's going to have our materials on there, right?
Mm-hmm.
That has our contact information.
Okay,
I can give it to you verbally, but it's probably better if your students just look at that information and then just shoot me an email and say, this is what the deal looks like, and then I'll provide copies of what we need from the buyer and start that process.
That's awesome.
Our client is the seller. Our client is not the buyer. So our relationship is with the person who wants to sell and carry the paper.
Right. That's good.
We do have sometimes contact with the buyer, but only in the sense they may not understand what paperwork I need or something like that. But for the most part, I'm going to be dealing directly with the seller.
Right. Now, you're not doing the the mortgage or deed of trust or note or land contract or any of that, are you?
No, we don't prepare loan documents.
Yeah, I didn't think so. I just wanted to clarify. And what do you charge for offering the RMLO services for a seller doing a seller finance transaction?
It's $350.
What?
That's it.
Everybody else I've talked to has been anywhere from $750, $850, $1,000. I saw one that was $1,250.
Well, it depends on what you're doing. If you're asking me to draw documents, it's going to be more. If you're asking me to make an underwriting decision, it's going to be more.
Right.
But I don't think most people want me to do that. I think they just want me to analyze the paperwork and give them a report. And it's kind of like an appraisal to me. An appraisal's, I don't know what it is in your area, but an appraisal out here is $450.
Right.
And so I feel like that's the type of work I'm doing. I'm just analyzing the deal to provide that information.
What kind of turnaround time do you have from the time that, let's say, the borrower gets you everything, right, until we can get a report?
3 to 4 days.
Okay, that's not bad.
Depends on if it's on a weekend or if it's if I get it on a Monday, I'll probably have it out by Wednesday.
Great.
It's just a question of if it's over the weekend, I can't pull the credit, that type of thing. There's some things that interfere with it, but for the most part, 3 or 4 days usually when I get it back to people.
Do you find many of these borrowers, it's tough to get in touch with them? They don't return calls, they don't follow up, they don't get you what you need?
I don't pursue them. I let the sellers pursue them.
Right. Good.
So, but there have been some situations where the buyer doesn't understand what it is that I need, or they're incomplete in the application.
Right.
That does happen, and I'll shoot them an email saying, I need you to complete page 3 of the application or something.
Right.
But when I have a complete package, it goes pretty quickly.
And it's my understanding to qualify for Dodd-Frank or to be Dodd-Frank approved or whatever, the RMLO, you have to take the credit application, but am I assuming it's okay for me as a seller to collect the pay stubs, the W-2, copy of the Social Security card, 2 years tax returns, that sort of thing?
Yes, you're a creditor.
Right.
As a seller, you become a creditor, and so you have a legal right to see that information. And in fact, in our report, we provide all that information in a box account, like a Dropbox account. We give you the link to that.
Good.
So even though they don't deal directly with you, and they may provide the information directly to me, you're still going to have access to review that information and see the credit and see the pay stubs and the bank statements and things of that nature.
Man, it's such a relief to be finally talking to somebody, and I'm really looking forward to working with you, to talking to somebody that gets it. I got to tell you a story. I actually sent a deal to an RMLO that I tried, and they underwrote the person. They said, yes, they qualify. They would not send me anything. They wouldn't send me any of the documents that the borrower signed, any of that. They said they can't because of privacy laws. I'm like, I'm the creditor. I'm the creditor, right?
Right.
They wouldn't send it to me.
It used to be that we couldn't even provide the borrower with a copy of their credit report. That was prohibited.
Wow.
The laws changed to allow us to do that now, but we couldn't even give them a copy of it. So, there's sometimes the old school philosophies tend to creep into our day-to-day business, and when you've been in the business a long time, it's hard to change those old habits that you've gotten used to. And maybe that's what happened with your RMLO, is he was just used to privacy laws and
maybe so
didn't realize it. But you are the creditor.
Exactly.
So.
I've called people up to talk to them about this, and they're like, I don't know. This sounds kind of fishy to me. I don't understand this. I had somebody one time said, this sounds like a scam. What are you talking about? It's crazy.
It is. It can be. But, we try to be professional about it and try to make sure that we're doing the things properly. And so, I'll say no to things, and I'll say yes to whatever I can say. I mean, that's the reality.
That's awesome. So I've got one last question that I want to ask you. You mentioned about a typical deal. They're going to sell it for $50,000 with $1,500 down. That almost sounds like a tenant to me, not a buyer, with $1,500 down. What do you, as an underwriter, if you were going to buy that paper, and I understand it's not the only qualification, but what kind of down payment do you like to see?
As I mentioned, I teach a class on financing. And one of the things that comes up, and I ask people, would you ever sell to somebody with zero down? And certainly most of the people in that class will raise their hand and say, no, I've never, there's too much risk. You're never gonna be able to get your money back. It's just high risk. It's not worth the risk.
Right.
And then I ask this question, what about a VA loan? And a VA loan is 100% financing. And it's only to a veteran.
Right.
So is a veteran a better credit risk than a non-veteran? Just by the very fact that they served in the military, and we appreciate the fact they served in the military,
right.
Does that make them a better credit risk? And in my opinion, it doesn't. So if I'm going to make a VA loan, if I'm going to give a home buyer 100% financing because they qualify for a VA loan,
right.
Why wouldn't I make that person who has the exact same qualifications a 100% loan if they are not a serviceman?
Right.
And in that discussion, we have a 5-10 minute discussion after that about, why is VA better and why servicemen
right.
and all this stuff. But the whole point is that if you're willing to make a 100% loan to a serviceman, why aren't you willing to make a 100% loan to a non-serviceman?
Right.
Because being in the service has nothing to do with your financial abilities, your mindset, any of those other types of things when it comes to paying your bills.
Right.
So I look at loan to value and I say, well, how much of a down payment would I really want? Well, the more the merrier. Obviously, if they have more skin in the game, I'm going to feel safer about that deal. But that does not mean that I would not do a seller carryback with $1,500 down if I had the confidence that they were going to be able to pay. And
right.
That's a gut feeling that I would have. And then the guy who puts $80,000 down on a $100,000 property could get run over by a truck tomorrow. And then what happens? You're well protected, but you still have to go through the headache. So I just look at things I try to be more practical and realistic than so rules driven. And you have to have policies. You have to establish certain guidelines that
right.
you operate in. But for the most part, I want to be flexible so that I can say, yeah, I'll sell with $1,500 down, and I'll carry back because I feel like this guy's is a teacher and or whatever it may be, and he just had a rough time in 2012. He had medical problems, and now he's back on his feet. I'll sell to him. You see, you just have to use the logic behind it.
That makes sense. That does make sense. I've never sold a house for that low down. I try to get a minimum of, even if I'm just selling a house for 20 or 30,000, maybe I picked it up for 5 or 10. I'm still going to try to get a couple $1,000s down, right? But, and I guess my whole line of thinking is, if they stop paying, if I do have to foreclose, if I can't just get them to sign a deed in lieu or whatever, if I do have to foreclose, it might be a long process before I get that house back,
You're facing time, the cost of the foreclosure, and then any repairs you're going to have when you go back in.
Right.
And resell it, and then resale costs.
Right.
So you're going to be looking at, a fairly expensive bill, and it's not going to be covered by that $1,500 or $2,000 that you get down. So your decision is going to be based more on whether you think you're going to end up with that property or not.
That makes sense.
And you just look at it logically. When you buy a piece of property, don't you look at it and think of the exit strategy out of that property? Think about what you need to do and how you're going to get out. You make a logical assumption based upon that strategy, and that's just the way I look at paper as well.
That's right. That's good. Yeah, and you buy paper nationwide, right?
Yes.
That's good. That's good. So, Mark, I got to tell you, man, I really, really appreciate you taking the time. This has been really, really informative. I've learned a lot of good stuff, and I can't wait to start working with you and sending some deals over to you to have you underwrite them. And I hope our students do too. And I just really appreciate you taking out the time today.
Well, Larry, thank you for the opportunity. We always like to get our name out there and branch out and get some more opportunities for us to do business as well. So we thank you for the exposure you're giving us.
Awesome, man. Thanks a lot. I really appreciate it.
All right. Take care.
You too.